This is the Albertsons LBO presented by Group 6. The transaction occurred in June of 2006. Part of the reason that the Albertsons deal was so appealing is because they owned a significant portion of their retail space. Albertsons owned roughly 60% of all retail space. The actual size of the transaction was $17.3 billion, which still today is the second largest retailer buyout in history. The transaction involved separate parties for real estate, grocery, and pharmacy segments. In September 2005, Albertsons hired Goldman Sachs and Blackstone Group to explore strategic opportunities. On October 21st of 2005, Kroger made an offer, presenting tremendous synergistic opportunities. In December 2005, SuperValu and Cerberus placed a bid, and after over a month of negotiations, Albertsons accepted the offer from SuperValu and Cerberus.
Albertsons was founded by Joe Albertsons in 1939 in Boise, Idaho, and was known for its large stores and fine foods. In 1959, Albertsons initiated its first IPO and went public. In 1969, Albertsons partners with Skaggs Drug Centers to open up the first combined grocery store drugstore. In 1977, that partnership was dissolved, and each company taking certain stores across the United States. By the mid-1990s, Albertsons was the number 4 grocery chain in the United States with about 800 stores in 19 states and revenues approaching $12 billion. Other companies such as Kroger and Safeway, seeing Albertsons' rapid growth, decided to take a very aggressive emphasis in advertising. Albertsons, seeing their market share decline, decided to change their emphasis on advertising to everyday low prices. In a report done by Metro Market Studies in 1999, Albertsons had the number 1 share in only 11% of the market and was number 4 or below in 46% of the market. By the end of the year 1999, the combined Albertsons American Stores entity solidified itself as the number 2 player in the U.S. supermarket sector with 8.9% of the market, surpassing its next largest competitor by 2.7%. In 2001, Lawrence R. Johnston was named chairman and CEO, becoming the first outsider to lead the company. Even up until the LBO, Albertsons was looking at acquiring with several other smaller companies.
The capital partners involved are SuperValu, which plans to acquire 1,419 of the top performing stores. Cerberus Capital plans to acquire 655 of the worst performing stores. CVS Pharmacy plans to acquire 703 of the freestanding drugstores, and Kimco plans to sell off the real estate from the closed stores. SuperValu Incorporated is a United States grocery retailer and distributor that is headquartered in Eden Prairie, Minnesota. It has been in business for over a century and is the 3rd largest food retailing company in the United States, behind Kroger and Safeway, which are SuperValu's main competitors. SuperValu is ranked number 51 on the Fortune 100 list. SuperValu has grown to such a large company through a series of acquisitions. In 1971, it acquired Shopko, which was later spun off in 1991 to form a separate, publicly traded company. In 1975, it acquired Hornbachers. In 1980, it acquired Cub Foods. In early 1990, it acquired Scott's Food and Pharmacy. In 1999, it acquired Rich Food Holdings, and now in 2006, it acquired Albertsons. The next major player in the transaction was Cerberus. Cerberus Capital Management is one of the largest private equity investment firms in the United States. It is based in New York City and run by financier Steve Feinberg. Cerberus was founded in 1992, and throughout its 30 years of existence, it has been an active acquirer of businesses and has large investments in automotive, sportswear, paper products, military services, real estate, energy, retail, glass making, transportation, and building projects. It currently holds over $24 billion in assets. Cerberus's main competitors are KKR, the Carlyle Group, and the Blackstone Group. The next company involved is CVS Pharmacy. CVS is the second largest pharmacy chain in the United States after Walgreens. Walgreens and Walmart are its main competitors. CVS operates over 7,000 stores in 41 states and Puerto Rico. It was founded in 1963 in Lowell, Massachusetts, and is now headquartered in Delaware. The last company involved in Albertsons LBO was Kimco Realty Corporation. Kimco owns and operates North America's largest portfolio of neighborhood and community shopping centers. It currently owns interest in 948 shopping center properties amassing 138 million square feet of leasing space in over 44 states, Puerto Rico, Canada, Mexico, and South America. Its competitors are the DDR Corporation, the Macrit Company, and Regency Centers Corporation.
Legal and regulatory. This transaction was subject to SuperValue and Albertsons stockholder approval, antitrust, and also regulatory approvals. Albertsons shareholders voted to approve of the transaction at a special shareholder meeting held May 30th, 2006. March 14, 2006, the pre-merger waiting period for Albertsons' proposed transaction with SuperValue, CVS, and a consortium led by Cerberus Capital expired, indicating that the Federal Trade Commission had completed the pre-merger review as required under the Hart-Scott-Rodino Antitrust Improvement Act of 1976. SuperValue agreed to a termination fee of $135 million payable to Albertsons, as well as Albertsons agreed to pay a fee of $276 million if the deal was canceled. Lazard was the financial advisor to SuperValue on the transaction. Goldman Sachs and the Blackstone Group advised Albertsons Inc. Lehman Brothers, UBS Investment Bank, and J.P. Morgan Securities were the financial advisors to the Cerberus-led group. However, Lazard advised Cerberus solely. Stuart D. Freedom from Schulte, Roth, and Zabel LLP acted as the legal advisor to Cerberus Capital Management.
Composition of financing. Albertsons LBO was projected to be $9.6 billion or $26 a share. The total deal was projected to be valued at $16 billion, with $6.4 billion financed using debt. On June 2, 2006, Cerberus Capital Management, CVS, and SuperValue acquired Albertsons Inc. for a purchase price of approximately $11.37 billion. The enterprise value of the entire transaction was $17.36 billion. The transaction was financed using $2.7 billion in cash, $2.3 billion of SuperValue common stock, and $6.1 billion of debt. SuperValue purchased approximately 35 million corporate units at a price of $25.22 per corporate unit, and later purchased approximately 4 million corporate units at a price of $25.52 per corporate unit. The debt to capital at closing was approximately 65%. By the end of the first year, SuperValue expected the debt to capital ratio to be at 62%. SuperValue planned to be paying off the debt at least $400 million annually. SuperValue's total debt to EBITDA was 7.219 times in February of 2007, and the transaction occurred during June of 2006. And you can see that it became a lot more heavily leveraged because of the LBO transaction. The current ratio below shows the ability of a corporation to pay off its debt. A ratio under 1 is not a good sign, and you can see in 2007, after the LBO buyout occurred, SuperValue's current ratio dropped to 0.99 and continued to drop to 0.94 in 2008. The debt-to-capital ratio shows the portion of debt used to equity in the financing, and you can see in 2007 it was significantly higher due to large debt financing of the LBO, and it was reduced to 59% in 2008.